Baptiste Possemé. I'm the manager of the Power System department at Enadata.
And I'm Adrienne, and I work as a power system analyst here at Enadata.
We're going to start by introducing briefly Enadata and our latest work on power price projections, and we'll dive afterwards into a more detailed presentation on the recent trends and the evolution, in particular, of the financing of solar PV, the impact that recent trends had on power prices, and the long-term trend that we can expect for those PPAs in particular. So a few words on Enadata. Enadata, we are an energy research and consulting company. We are 35 years old, over 60 people, 50 consultants and experts working on energy and climate issues. We are based in France, in Grenoble, with an office in Paris and another one in Singapore. Historically, Enadata was a spin-off of a research center based on the development of a model focusing on the long-term energy trends called the poles model. This model is still extensively used today for sale, but also by many stakeholders at EU level, at government level throughout the world. And this poles in the data model is as a global scope. It's used to estimate from hypotheses on available resources, socioeconomic assumptions, technology cost assumptions, the evolution of energy demand, of energy production, of installed capacities concerning electricity. But the key point to have in mind here is that this model is not focused on power only. It takes a 360 view on the energy markets throughout the world. To fit this model, initially we needed a lot of reliable energy statistics and data. Therefore, we have built what we call the Global Energy and CO2 database, which is a database of basically any kind of statistics you may need for energy markets, and we have extended that with a dedicated, very granular view on energy demand and the pathways and the drivers of energy demand. Additionally, we have been working extensively on the modeling of at EU level of the CO2 prices, so EU ETS prices, in particular with utilities. At the moment, we're working very closely with the European Commission, using those tools to help decisions on the future of the EU ETS market in Europe. To get a better national view on things, we are also building dedicated energy country reports where we'll have a deeper look at national objectives, existing companies, latest trends, any type of announcements, for instance, phasing out coal or nuclear energy. And at asset level, we have a dedicated power plant database in which we track all the operational power plants, but also the announced project with estimated chances of seeing those projects being installed. And all those model databases, trackers, reports together are actually being used today for latest power price projection product. So basically, power price projection is a product in which we sell at EU level long-term hourly projection for the electricity spot market. We're using an in-house model based on the open source library PIPSA. And it's a fundamental model. We'll detail that a bit more afterwards. that can be used to also estimate any type of what-if scenarios or risk analysis or any kind of on-demand scenarios. Now, let's talk a bit about PPAs, in particular about solar PPAs. We'll keep during this presentation European focus. We can give a bit of context on other regions, but here the main topic is really at EU level, and in particular also on the development of PV at EU level. So the broad view is, if we take the system between a PV producer, a consumer on the other hand, and in the middle, in type of financing, let's say a bank, an asset manager. On PV producer side, we are seeing first LCOEs that were for the first time in 2025 actually not decreasing in EU in terms of LCOE. So the cost of solar is still low, but the trend is not as decreasing as it was a few years ago. We see also, we'll give more detail on that in the next slides, but globally, a shrinking public tender volume in many countries, where there is a trend toward the progressive decrease of state subsidies towards solar, but also on the market side, a declining capture rate, meaning that it's getting more and more difficult to find a relevant price at which one can easily sell solar energy to an end consumer. And from an industrial consumer perspective, for instance, the energy prices are still a key issue, especially considering competition issues with China, with the US, to name a few. But prices have been decreasing since the 2022 crisis, and we're in the middle of this crisis, securing energy procurements in the expectation of a new crisis was, for many, a number one priority. It's less obvious today. We are still in a very tight economical context for many consumers, as I just said, and especially given the current political context throughout the world, we are in a phase with very high level of uncertainties and risk exposure. It means also that in the middle, the bank or the asset manager needs to find new ways to finance to lubricate, I could say, to ease the development of projects, but with projects that are getting more and more complex, and where it's less and less obvious the way that energy can be sold from the consumer, from the producer to the consumer. If we look first at public tenders, so basically, if you want to finance a PV project, you have three main sources of financing. The first one, I would not detail it too much, but it's feed-in tariffs. It's mainly focusing on small projects and decreasing pretty much everywhere in Europe. The second one is what's called a power purchase agreement, where we have a private contract between the producer and either a utility, an aggregator, or an end consumer. And the third one that was especially for large solar power plants, so above 500 kilowatts, where the first source of financing, and is in many countries still the first source of financing for projects, is auctions, where the government will publish a tender and PV developers can bid, and the lowest bidder will get a long-term fixed price with a lot of different possible specific conditions. I won't go into too much detail on that, but that allows for long-term visibility on the remuneration of the asset. And if you look on the left here at the dotted line, that is the total of awarded PV capacity in the EU, you get the feeling that 2025 was a very good year because awarded PV capacity has been strongly increasing from up to 25 gigawatts total. But if you look at country by country detail, this increase is almost solely due to Italy that auctioned so the Ferrix auction with 8 gigawatts of PV that were awarded. It's a record, absolute record in the EU, but with very few visibility on the future of these tenders or the publication of the next one. In the rest of the EU, public support has been either decreasing or stagnating. If you look at France here, for instance, if you look at Poland, the rest of the EU. If we take the example of France, the PPA 3, that's so the text that defines the midterm orientation towards renewable energy in France, set a limit at 2.9 gigawatts per year, where 6 gigawatts were installed in 2025. And in a context where actually the backlog from past delayed projects may already feel the upcoming tenders. So from our perspective and from the feedback we get speaking with project developers, there is very strong, let's say, fear, strong expected risk of strongly declining public support for PV, at least the way it's done at the moment. If we look at PPAs, so private contract between the producer and either utility or an end consumer, when you're trying to do a PPA, basically you need to find a certain price at which you will be able to sell electricity. For the last 5 to 10 years, most of PPAs for solar were pay as produced, meaning that the off-taker will buy the energy that is produced by the solar asset, no matter what is produced. Or sometimes they will be able to define like a production profile that's very close to the expected production profile of PV. But basically, you will buy electricity when sun is shining. And in this context, the settlement price will be something in between the cost of producing this electricity, so the LCOE for the PV asset, and the price that the off-taker expect to get alternatively from the market, from the spot market with risk markups. But this price is called the capture rate or capture price. And those are two very important indicators to look at when talking about PPAs. Basically, the capture rate is the difference, the percentage of the average spot price that you could get by selling PV electricity on the market. And in particular, if you sell your electricity only around noon when the sun is shining, it's also when prices tend to get lower and you will get a lower price. This capture rate has been steadily decreasing since 2021 throughout Europe, with very different actually level of decline. If you look today, for instance, in Spain, so on the 12 last month, on average on the 12 last months in Spain, if you sell electricity on the market from a PV power plant, you'll get only 50% of the average spot price. In Italy, northern Italy, actually, it's 87.5%. So there is a very strong difference between countries, and also a very different interest on purchasing for such PPAs. it's important to keep in mind that if you look at it from a price perspective, even in Spain, where the capture price has been going down to 31.9 megawatt hour, it's still quite close or even often higher than the price that it was before the energy crisis. Oh, sorry. And why have those capture rates been declining? It's basically if you look at daily power prices, here is the example of Spain on the left. You can see that the power curve, even with a similar average price, the price curve, sorry, the daily price curve month after month has been getting lower and lower during the day and higher and higher around the 2 daily peaks. That's what called the duck curve effect that most of you probably know pretty well. And why does this happen? It's summarized on the right here. It's that basically if you take the last 6 years, so 2019 to 2024, the share of PV in installed capacities has pretty much doubled. But at the same time, electricity final consumption in Europe has been decreasing. So we have more capacity for less demand. And basically, meaning that you will have, especially during the day, another capacity of PV relative to other available technologies. From a consumer perspective, so a large consumer, industrial consumer in particular, a large share of them now tend to have what we call block plus spot contract, where you will secure a large share of your electricity, something between 70-90%, depends on the production profile, on calendar products, which is basically meaning that you buy 1, 2, up to 3 years in advance a base load of electricity for a full year at the price that the market now expects electricity to be by then, which is called so the calendar. And the rest is directly bought on the spot market, so day after day. On the left here, we have the evolution of the calendar year plus 2 price. So today's expectation of what the price will be in 2 years. It's interesting to see. So the graph goes up to a few days ago, so 13th of April. It's interesting to see that compared to the 2021-2022 crisis, with the combined effect of nuclear corrosion, Russian invasion of Ukraine, climate condition as well. The current context with the ongoing war in Iran, for instance, has a very limited impact on calendar power prices at the moment. We'll see how it evolves in the next months, but at the moment the impact is still very limited. And in France or in Spain, the calendar prices are almost back to the price that they were before the crisis. If you look at it from a retail price perspective, so on the right here for different type of consumers, the price that industrial consumers pay has been decreasing, but not as fast. This is due to a delay effect where since the volumes that people are consuming are about 1 to 3 years in advance, if prices are decreasing now, it will take up to 3 years for this to be visible on all the consumers' bill. What does it mean for solar PPAs? We took here on the left part of the slide 2 different sources for the evolution of PPA markets in Europe. One from Pexapark, another one from Solar Power Europe. It's important to keep in mind they don't show exactly the same thing. The bottom one is corporate PPAs only. The top one is all PPAs, where utility PPAs represent roughly 30% of the total. And also, it's important to keep in mind that there is no, at the moment, no exhaustive database of PPAs. Those databases are based on public announcements, so a share of them are not disclosed. But what's interesting to see is that although the PPA activity has been declining in 2025 compared to 2024, two exceptions can be noted, Italy and Poland. And if I go back a few slides to here, you can see that there are actually the two countries that have the highest capture rate at the moment among the countries that we have been looking at. So this increase in those markets is simply due to the fact that the strong penetration of PV is not as visible as it is on other countries, and they tend to have a less pronounced curve on their power prices. One last thing to keep in mind is that despite strong levels, for instance, in Spain of PPA activity, we're not talking about the same thing when talking about a PS producer or PPA in Germany or in Spain. The price that you can see on the right graph here, at which the PPAs are usually settled. And once again, a lot of those PPAs the prices are not disclosed. Is almost double in Germany compared to Spain on average on the 3 last years. So to summarize this first part, we see a very decline of the interest of pay-as-produced PV contracts, PV PPAs. It's not as so there are strong regional differences between countries. For instance, Italy and Poland are very different than Spain and France. And there are also multi-speed evolutions that can be due to a backlog of past projects, different level of state subsidies that incentivize or not the switch to private deals. But the global trend is that the pay-as-produced PV PPA is slowly but steadily dying. And a new model today for PV financing must emerge. We'll discuss more about it at the end, but there is no one-fit-all solution yet. Some want more complexity to have solutions very fitted to one particular need. Some want more standardized solution that can be adapted to smaller consumers as well. So in any case, the impact of power prices will become more and more important, and not only the average price or not even only the capture rate, but also the ability to include climate risk, to include battery penetration, hybrid PPAs, and we'll discuss more about that in the second chapter. Last thing, the buyer's profile of PPA is also shifting. Because a large share of the very large companies that had that were able to buy a 10-year PPA with a fixed price that would only represent a small share of their consumption. Those people, they have bought their electricity, and now PV developers tend to go to smaller off-takers that will be also more demanding in terms of price level, in terms of risk that they'll be taking. And talking about risk, with those new models, PV is not considered a low-risk asset anymore. Speaking with different banks or asset management companies, a lot of PV projects, especially the ones that were on public auctions, were seen pretty much like a real estate asset, meaning that you will get a long-term stable revenue and you can finance such project with very low interest. While when you get more and more dependent on poor prices, on the risk associated to the decline of capture rate, this business model is getting more and more like an innovation model, more almost like a startup model. And this risk evaluation and asset valuation will be key also for all those stakeholders.
Hi everyone, so I'll be taking over to present to you how we are modeling power prices here at Enerdata. So there are several ways to forecast what could be the prices of electricity. If you focus on the short term, then you'll maybe use statistical models or regression models. The advantages of a statistical model is basically it reproduces seasonal it's based on historical data, so it will reproduce historical trends and also the seasonality, and also it's a pretty fast way to model prices, but it doesn't reproduce any spikes. If we use machine learning approaches, then we can add additional exogenous data. So we can model a nonlinear relationship, but the inconvenience here is it's a black box model, so we don't know what's happening inside. If we move towards a midterm to a long-term future, then we'll use more fundamental models. And here we distinguish two types of model. We can distinguish dispatch model and also capacity building and dispatch model. Here at Enerdata, we choose to focus on a dispatch model that only models the operational decisions, so when to commit which unit and when to turn it off. And it doesn't take decision into investment decision. That would be a capacity building model, also called an expansion model. But here we wanted to focus on the dispatch because that's what reproduces best what we call the day-ahead spot price. Because it's based on a fundamental logic, it reproduces the merit order, and by reproducing the merit order, it reproduces the day-ahead spot price. So there are a lot of sensitivities inside this type of models, and we chose here to distinguish them into three different categories. The first category we call systemic factors. It's basically all the uncertainty we can have on what will be the power demand, what will be the installed capacities, what will be the policy changes, or also the long-term evolution on costs, the gas costs, the CO2 prices. To model and to capture also these uncertainties and these systemic factors, we use three distinct scenarios in our model. We use the Enabase, the central, and the Enablu scenarios. And then we have two other types of uncertainty. We have the risks and the uncertainty. The risk, basically, it's when we know what could happen. We don't know what could happen, but we can put some probability on it. So we know what the different futures could be, but we also can put some probability on it. So basically, how much wind we will have, how much sun we will have, how likely a power plant or interconnection is to go down, to be out of service. And to capture this risk, we'll use a stochastic optimization, basically running several times the optimization, each time applying a different probability on the results based on the probability of the inputs. And then we have uncertainty. And for uncertainty, we don't know the probability. We don't know how likely the events are to happen. And actually, we don't even know what could happen. It's basically a commodity crisis, a war, like linked to a war. How long will the Iran crisis last? It's also a lot of unforeseen unavailability event, like a nuclear corrosion event, such as what happened in France a few years ago, or a pandemic. And to capture this uncertainty, the best way is to use what-if scenarios. Basically, we take a standard scenarios and then we push one input into a direction to see, okay, if we stress test our model, what would be the prices? But it's basically a what-if scenarios, but we really don't know how likely it is to happen. And so far in our project here at Enea, so we have already we have already 3 scenarios available, the Enea Central and the Enea Blue scenarios. And we also have risk analysis, which are available on demand, and we can also provide what-if scenarios on demand. So I've told you about our 3 scenarios, and they are really distinguished in terms of demand and regulatory. So if we go from the left to the right, we'll start with the Enea scenario. Enea scenario is basically business as usual scenarios. So where we take the outputs of our Enea future projects, and it gives us the installed capacities. And yeah, in the Enea scenarios, we don't decarbonize that much because we assume that the policies going for decarbonization are not really being following through. So there are little decarbonization, and it's our scenario with the most carbonated power mix. And then on the far right, we have the Enea Blue scenario. The Enea Blue scenario assume very ambitious decarbonation targets, and we reach the NDC targets, each country NDC targets. So this is almost decarbonated scenarios, and in between we chose the central scenarios. And for the central scenarios, we also chose to have a delayed electrification of power demand. So energy demand on the next 5 years, well, the trajectory is, we assume that on the next 5 years, power demand will decrease or stagnate, which has been the tendencies in most countries in European Union for the last few years. And for the capacities, we chose to have an average of the Enea and the Enea Blue scenarios. So there are a lot of uncertainty around the demand level. And so on the graph on the right, you can see that our 3 scenarios here are very can be distinguishable toward how much demand we will achieve. Some peak at more than 2100 terawatt for our European countries we model here. And the uncertainty is quite large because it can go also be 300 terawatt or lower. So there is a lack of reliability on how much demand there will be, but it's intrinsic and we cannot change it. And if we take our hypothesis here at Enea and we compare it to other entities like Total, IEA, and so your electrics, we have the most conservative assumptions regarding power demand. One reason is that our power demand comes from the result of our poles in our future model. And the poles model is global energy, but it's also a multi-energy. It's a global model, but it's also a multi-energy model. Basically, the energy that is not being satisfied through power can be satisfied through other energy vectors, such as coal, gas, and sufficiency. So this is the reason why all electricity is lower. I mean, power demand is lower in our assumptions. And the impact on price is quite stark. So if you remember, the central scenario is a scenario with the lowest demand and also with the lowest electrification pace, because there is a 5-year wait time before the electrification picks up. And it translates pretty easily into the prices. Here we see that the central scenario has the lowest average spot price out of all our scenarios. And if we look at the capture price of solar, so the average price but weighted by the hourly production, we see that this effect is pretty stark. And on solar capture price, the price can decrease by 41%, where demand is only 12% lower. Another stark uncertainty here we wanted to capture is uncertainty on CO2 prices. So we have at Enerdata a product called carbon price projections, and we use this product to have carbon price, trajectories on the future. And you can see here on the graph on the right, what will be the carbon prices, what could be the carbon prices on the next 30 years. There is large uncertainty on CO2 prices here in the European Union because there is an ongoing reform of the EU ETS mechanism, and the impact of this reform, I mean, the reform is not yet finished, so we don't know the impacts of this reform. And it has quite a big impact, the price of CO2, because if you look at the gas price, so on the left, you can see that the CO2 price on average weigh around between 20 and 40% of the gas production cost. So production cost being how much it costs for a gas power plant to produce electricity. And we also see that in the last months, because gas power price increased pretty importantly due to the crisis, the relative importance of CO2 prices has been decreasing, but it remains quite important on the future. And so if we look at the far future here, we see that the day-ahead prices on the left, and we take the Enerbase scenario. So the Enerbase scenario is our least decarbonated scenarios. And we see that because it is our least decarbonated scenarios and we have a carbon price trajectories that increases towards 2050, we see that the power price in the Enerbase scenario increases by 2045, 2050, and it's mainly driven by the CO2 price here. We also see that this effect of the CO2 driving the prices is most strong on the night hours. So if we look at the right graph, and still taking the Enerbase scenarios, and we look only at the night hours, we see that between 2024, 2030, 2040, and 2050, we see that the average price go from around 100 to 200 euro per megawatt hours. And this is here mainly driven by CO2 prices, because gas power plant mostly produce during night hours. And so we have in our carbon price projections project, we have 3 trajectories. We have a low, a central, and a high trajectory of power prices. And so we wanted to do a sensibility analysis. And so we took the same model as before, what I presented to you. And here we took the low scenario, so around 394, sorry. And also we took the high scenario at 648 euro per ton of CO2. So this is a minus 22% and a plus 22% variation compared to our central scenario that I presented to you just before. And the impact on price is a little bit lower, but it's quite important still. So the prices could be around minus 20 to plus 20% basically here in 2045, which is, yeah. So this basically means that the CO2 price has a strong impact, and this impact is mostly driven during night hours. And if the least decarbonated the scenario is, the most important the CO2 price is in the overall power price. And we also wanted to have some idea of what could be the impact of gas prices evolution. So we took the year 2027, and in 2027, the gas price we assume our initial hypothesis was 43 euro per megawatt hour. And then we say, okay, what would happen if we doubled or triple this price? So going to 85 or 128 euro per megawatt hour. So we rerun our model on the year 2027 on the central scenarios. And what happened is that the power price, of course, it increases, and this increase, so increasing the gas price by 100% led to an increase of the power price by 30%. And it also means that if we look at a historical crisis, like the crisis that happened in 2022, so prices multiply around ×2, yeah, it shows that the uncertainty of power price is quite important, even on the short term. And a crisis such as the one that is currently ongoing can have a very strong impact on power prices, leading to an increase of 30% on the average power price.
Okay, we'll say a few words of conclusion, the future of PPAs and the impact linked by the price sensitivity that Adrian has shown. In the meantime, if you have any question, do not hesitate to fill it in the module. That way we will have time to read it before answering at all. As we said earlier, the impact of the current trend on the power prices is already visible throughout Europe. And the produced solar PPA that were only using or mostly using the PV capture rate is getting less and less common. And we see throughout Europe different approaches to counter this, to keep financing PV in a context where public subsidies are decreasing, where power prices are seeing a strong cannibalization effect. We want to name a few here. As I said earlier, there is no one-fit-all solution, and we will watch closely in the next months, in the next years, which examples become the most prominent, or the one that will be considered not the best solution. To take a few examples, we see more and more baseload PPAs, renewable baseload PPAs. We named a few here between Total Energies and various companies in France, actually. One also with a company called Altena Energy, that in which the provider, so the producer or the aggregator, will be aggregating PV plus battery plus wind often to really produce something that it's very close to a calendar product. So you will buy a constant supply of electricity for a given price. The key issue here is to provide more readability, simplicity to the off-taker. On the right side here, there's something very similar, but not exactly the same. It's more on the off-taker side to develop more and more 24/7 carbon-free energy supply strategies. So it can use the baseload PPAs that I've been mentioning earlier, but it's basically from the consumer, the initiative to adapt its supply strategy, to adapt also its self-consumption strategy, its demand flexibility. It can be also used to better adapt its consumption to better fit the production profile of renewables, available renewable production. The key leader in that field has been Google, but has been followed especially in the data center area by several stakeholders, in particular Microsoft, Iron Mountain, and that often have developed partnership with utilities, can name here Vattenfall, Statkraft, Engie, to build this supply strategy for a given end user. From a state support perspective, on the top middle here, it's interesting to see that there are more and more development of auctions with including storage, but we haven't seen yet two countries with the same approach to it. For instance, in Germany did specific innovation tenders for targeting PV plus storage. Italy did at the end of 2025 a tender called the Max tender, and that was focusing on PV only, where they would create a dedicated storage market disconnected from the power spot market that can be used from so basically the Italian state will provide a stable remuneration tool fees to the battery owner, and the battery and it will sell the battery capacity to displace electricity to other market participants. In France, it's more recent, but there is a very recent note from the CRE, the French regulator, on the encouraging hybrid project, but from a price perspective, meaning that they want to encourage prices that will make non-battery projects non-bankable. From a power market perspective, we mentioned earlier the calendar products, and there is today officially a base load calendar product and a peak calendar product, but the issue is that the peak products are between, if I'm not mistaken, 8 a.m. to 8 p.m., which is definitely not adapted to the price curve that we see today. And EX, which is in Europe the main provider of long-term futures, has been experimenting on more specific products, Monday, Sunday peak calendar plus long-term calendar as well, that could be used as alternative to public auctions or long-term PPAs. But those are still experimentation at this stage and not generalized throughout Europe. Last but not least, there is also, especially with the development of, I mentioned earlier, hybrid PPAs, for instance, we saw, if I'm not mistaken, from level 10 data, so up to plus 13% of hybrid PPAs, mainly in Germany, in Spain, Poland. And the fact that projects will be more and more coupled with batteries increases also the need for participation in alternative revenue streams, in particular ancillary services that can, for which like the aggregator or the asset owner can use its batteries when it's not used for either self-consumption or PV production displacement, to answer the TSO's reserve needs that can at the moment be very lucrative. But we see also more and more PV, for instance, or wind participating, so curtailing their production to participate in such services. It's something that we look closely at in the data. It's important to keep in mind that those revenue streams also face a high risk of cannibalization effect with strong uncertainty on how high they will remain in the next couple of years. Thank you very much. We added here on this last slide links to our latest article on the power prices projection, and also a commercial brochure of a power price projection product. So if you're interested, do not hesitate to contact us even for any kind of question, discussion. We'll be very happy to answer it. In the meantime, we'll take a few questions and before closing this webinar. Okay, first question. In your power price forecast model, do you have to assign bid prices for all the different production types? If so, how do you fix them?
I can take over for this question. So in our power price, we have a marginal cost for each technology, of course, specific, and it can also be country specific. For example, The gas price varies from one country to another based on the local network taxes and local taxes. It's based on the Eurostat analysis. And so, yeah, of course, for marginal costs vary from one technology to another. We also use CO2 emission factor in CO2 prices, so that our marginal costs do include the CO2 price in the overall production factor. And in addition, we have a specified model for our gas power plants. So the gas power plants are modeled at a unit level. And for these power plants, we have distinct efficiency based on how long ago the power plant was constructed and what technology has been used. So we use we use information from our database. We have here Enadata that has all the power plants currently under ongoing operation, also the projected power plants. It's a database called Power Plant Tracker. And for these gas units, we take the original marginal costs, which does depend on the daily gas projection cost. And we have a marginal cost factor, we call it that way, that depends on the level of net demand. So if the demand is very high and renewable are very low, the marginal cost factor will be more important. And conversely, if the demand is quite low and renewable are very high, then the power plants will be at a lower cost. So the marginal cost factor will be lower, so that the price put on the market will be a bit lower. And so on average, we are around the marginal cost factor of a gas thermal unit, but it's more important when the net demand is quite high, and so that there might be scarcity events.
Thank you. Next question. Can you please explain again why the Enadata modeling leads to more conservative power demands projection compared to other scenarios? I can take that one. First, it's important to keep in mind that not every model is transparent, and there is also a lack of I do not have all the detailed hypotheses of alternative scenarios, but something that we can distinguish is that by using a multi-energy model, the Pulse model will tend to have more competition choices between technologies, especially between efficiency and sufficiency choices versus full electrification. And especially among power scenarios, you will have a lot of models that will be focusing on the power sector and using for that national objectives, especially from TSO scenarios. We looked on our side at TSO scenarios from most countries, and the issue is that they tend to be very optimistic in terms of electrification, especially because they represent the also electricity point of view of things. So the trade-off between gas and electricity can sometimes be not often modelized, and also they reflect objectives, and that's important to keep in mind. For instance, if you take the NSOSTY NDPs scenarios on demand, they do not represent what NSOA or TSO thinks that power demand will evolve in the coming years, but rather what should be done to achieve the national objectives in terms of electrification. And this is very different at the end. Another one, how often are your scenarios updated? Adrienne?
Yeah, so our scenarios are updated every 3 months. And we have minor and major updates, and the major updates include also the latest outputs in a future scenario, which fit into our power price projection models. And so this happens once a year, and we each 3 months there are minor updates on the data based on different sources, and also for the next 5 years we have detailed data, as I said before, from the power plant tracker database on projected installed capacity. So we tailor the outputs of the NR future scenarios with the outputs from the power plant tracker project, so we can have more realistic installed capacity trajectories. And we also update the demand trajectories for our central scenarios based on the latest trends observed over the last 5 years. And yeah, we have also some, we also include in our updates changes in the price trajectories and the signals, then the impact of seasonality, and everything is updated every 3 months.
Thank you. We'll see if we have time for a question after that, but we're almost at the end. Do the models take into account the impact from increasing solar uptake by households, or is the impact of this negligible? The impact is definitely not negligible. It's taken into account when we model the penetration of PV, we take into account all type of solar energy, so rooftop, utility scale power plants, as well as a smaller one from a household. And the specific impact from households can also be seen from the self-consumption perspective. For that, we use historical data on the injected power electricity from PV compared to the theoretical production of a solar asset that is not used for self-consumption. And maybe a last one. How does your model accommodate hybrid market structures where vertical integrated utility coexists with emerging competitive wholesale and bilateral markets? Which one? I can take that one if you prefer. The idea here is it's a question. It's a very good question because if you look at the spot market, the volume traded on spot market is very small compared actually to the overall consumed electricity, because a majority of the electricity that is consumed by end consumers is either bought on the future products, so the calendar products that I was mentioning earlier, on OTC agreements, on PPAs. In France, we had, for instance, up to the end of 2025, at year end, when up to 110 terawatt hours were sold at the fixed price of nuclear energy. But at the end, the spot market serves as a key indicator for most of these alternative products. As I said, the calendar is only the market expectation of what spot prices will be in a few years, and the fact that the spot markets works on a merit order basis means that you need to take into account in your modeling even the electricity, the demand and the production that is not directly sold on the market, to reflect a realistic spot price. And that's something that we see also in the way that we manage to reproduce past prices. Okay, thank you very much. We'll take the time to answer the remaining questions by mail afterwards. It was a pleasure doing this webinar, and for those of you for which it It is today now noon. Have a good lunch.
Thank you, everyone.